Hey everyone, taking a little time with my parents and some friends in the Mesa area of Arizona for a week, but didn't want to miss discussing all that's going on in the area of real estate and our economy. There's a lot going on right now I want to talk about. If you found me online, I'm Gary Nims with Windermere Real Estate in the greater Seattle area. Actually in Arizona right now, but that's the market I serve is the greater Seattle area. I'd like to talk about the Silicon Valley bank crisis and how that might affect our real estate market. So let me give you a recap. Here's what happened in a nutshell in case you haven't seen what's going on. So lots of cash swirling around during the low interest rate days, going back to the days of the pandemic when tech was in vogue and firms were raising huge sums of capital from venture capitalists. A lot of tech companies were receiving so much venture capital, and Silicon Valley Bank ends up with these deposits that these venture capitalists are depositing into their accounts. They end up with more cash than they can lend. So they take that money and they invest heavily in US long term security or treasury bonds. This allows them to earn a few percentage points on that money. And this works really low when or really well when interest rates are low. But treasuries trade inversely to interest rates. So when the Fed realized that inflation wasn't temporary, we all know they went on a hiking spree that we haven't seen in 40 years. So SVB or Silicon Valley Bank, they realize that they have these huge unrealized losses on these securities that need shifting, and they need to do it fast. Meanwhile, as the economy's changing, these tech-heavy customers need to start drawing on their deposits as rising costs and rates begin to hurt them. So the lender's solution was to sell its low-yielding long-term bonds and buy some short-term bonds that are doing better. The bank also sends out a letter to its shareholders saying that they're estimating that they have about a $1.8 billion loss on the sale of its bond portfolio. They also mention in this letter that they have plans to raise about $2.25 billion in capital to shore up its finances. So what was the response? Investors can't wait. The clients began drawing on these funds at a fast rate, making SVB insolvent. So here's the big rub. Investors everywhere are wondering, is this a one bank problem? Or are there more Silicon Valley banks out there who did the same thing? Well, we just found out our answer with Signature Bank in New York. They were investing in something slightly more volatile than treasuries, something like cryptocurrencies. So how can all this affect our real estate market? Well, this whole thing happened because the Fed raised rates so fast. Silicon Valley Bank didn't respond quickly enough. And so now here's the key. Everyone's telling Chairman Powell to halt the rate increases. He's getting political pressure to say slow the rate hikes down or stop the rate hikes. Goldman Sachs, the investor, they're estimating or they're saying we don't expect to see that 50 basis point or half an interest point rate hike at the end of the month anymore that they were expecting to see, no matter what the employment reports or the consumer price index or any of the other indexes are saying in the weeks ahead. So if the interest rate hikes stall, we could see property values climb again as we find ourselves in this inventory starved environment. We've already seen almost a half a point interest rate reduction since last week. So with all this going on, I want you to keep in mind, I've mentioned this 10-year study that Windermere did. They found that in our region, about 80% of the appreciation in a year comes in the first 6 months of the year. So from January 1st to June 30th, for example, if interest rate or if homes appreciated at a 10% rate, 8% of that appreciation happens from January 1st to June 30th. One more thing to keep in mind is in this market, there's a contrarian play that's made famous by Warren Buffett. And his axiom is when people are greedy, be fearful. And we've been through a very, very greedy real estate market in the last 3 years. On the other side of that, when people are fearful, be greedy. There's a significant turmoil in the market right now. And I'm going to say I'm looking for opportunities both for my clients and personally. for our family. So we're also looking at, we'll see Windermere's economist, Matthew Gardner. He'll discuss these happenings in the weeks ahead. So stay tuned to that. Those discussions are going to be posted on my blog section of my website. But for more thoughts or discuss your personal circumstances, please reach out. You can do so via my website if you found me online, or just give me a call if you're one of my existing clients. Gary Nims for Windermere Real Estate, wishing you prosperity and success. I'm looking forward to hearing from you, and bye for now.